Welcome. Hello, everybody. Thank you for being here today. We're so excited you can join us, both in person and also live via webcast. Thank you for joining us at our Wealth Matters client event, where we're really excited to introduce you to a conversation that myself and our illustrious Dr. Jim Thorne, Chief Market Strategist at Wellington-Altus Private Wealth, and I'm Miley Wong, Senior Portfolio Manager and Senior Wealth Advisor and Board Member at Wellington-Altus Private Wealth, will host a discussion that's going to be live and interactive and involve you as well to address some of the key things that are top of mind in this year in the turbulent markets, the interesting economy that we're currently facing. And we really hope that today is all about providing you a sense of reassurance, knowledge, insights, and confidence about the process which we really treat as something very sacred in terms of helping to navigate these turbulent times on your behalf. I really wanted to take an opportunity to introduce to you as well the fact that my team is here and has been working really hard behind the scenes to help create an environment that will be comfortable and safe for you to enjoy and really be able to ask the questions that were kind of lurking in the back of your mind or your back of your head and your heart around, what is really happening today in the global markets? What does it mean when you hear things about a potential recession, or when you face higher interest rates and changing dynamics on the side of whether it affects mortgages or lines of credits or even businesses that are making decisions in the world today? There's a lot of doom and gloom out there. I get it, I hear it, I sense it. I know that there's a lot of Canadians who are feeling anxious about what they're hearing and feeling in the markets today. So we wanted to address it head on and create a safe space to really talk about what are the facts and what are some of the insights that we can take away that aren't necessarily what you hear about in the news or in the media. And also share with you how we think is a smart approach to navigating investment portfolios in this type of environment. The good news is that we have tools in the toolkit to address the types of situations that we are seeing today and prepare for what we see coming down the road in the years ahead. And through sound, disciplined research and collective insights that we are gleaning from global thought leaders, we hope to distill some of those ideas to you today and share with you a bit about behind the scenes. So there's also some insights I wanted to share with you about our firm, Wellington-Altus Private Wealth, which has just celebrated its 3-year anniversary. Well, with us anyways. It's been around for longer than that, but we joined 3 years ago, and I'm happy to say that the firm has just continued to get stronger. And when we joined a few years ago, it was a growing firm and had about $7 billion in assets under management. Today, 3 years later, we're now 650 employees across Canada, 42 locations across Canada, and over $20 billion in assets under management. And after a number of industry awards, including Top Canadian Brokerage Firm of the Year for 3 years in a row. So we're pleased to have this growing and strengthening platform upon which to showcase independent, thoughtful thought leadership, innovative, but also deeply disciplined solutions on behalf of our clients, where we're always looking to find a better way to deliver the best of breed products as well as insights and investment strategies for our valued clients. Which brings me to my thank you. I really wanted to take an opportunity to thank you all for trusting our process. It's been an incredible 3 years here at Wellington so far with the pandemic, the changing economic landscape. And I'm happy to share with you that despite the really turbulent, volatile markets that we've been facing, where there's been significant drops in the equity markets and fixed income markets year to date, our client portfolios have been very resilient. And I'm really thankful for you trusting in the process and allowing us to navigate these turbulent times on your behalf. So with that, I wanted to start with a little setting the stage in terms of the context that we're in today. We're going to hear about how to position portfolios in this global economy. We're going to talk about the recession. We're going to talk about interest rates and inflation, and what the outlook is for the year ahead. But before we start, I wanted to start with a little bit of a different way of thinking about things, and hence that's the jelly bean jar here. Why do we have a jar of jelly beans? Well, it's not just because we wanted to give one winner in the room today a sugar high ahead of Halloween. It's really to illustrate an idea around how markets work. And the idea that we all make guesses in terms of how many jelly beans are in the jar. And some of us will guess a low number, some will guess a high, but interestingly enough, and this experiment has been conducted several times by Nobel Prize-winning economists, and what common outcome is that the average guess is oftentimes much more accurate than any individual guess, besides one or two, perhaps really good guessers, but there's quite a big range between the low and the high. And what does it demonstrate is the idea that collectively our wisdom is greater than it is alone. And when you think about it, there's two takeaways I have from that. One is this idea of collectively gleaning insights from really well-informed different sources is part of our philosophy as we go about when we have our investment management meetings and when we meet with different thought leaders in the investment industry like Jim Thorne, as well as our counterparts in New York at Cirrus, who many of you have met, and various different portfolio managers. We collect these ideas and really then apply our lens to help determine what are the right steps forward. So it's not just within our own minds, it's really taking the collective wisdom. The second takeaway is how markets work. We might have an idea, interest rates are going to do this, or a stock price should be that because this company is valued at X. But really the market is really like a gigantic information processing machine. It's like a big voting machine that takes all of the different ideas of what a company is worth and collectively reflects it in all the different buyers and sellers in that clearing price. So I want us to take that context as we go forward with our discussion today. Because yes, there's a lot of doom and gloom out there talking about rates going up, inflation going up, all of these things. But perhaps a lot of that has already been priced into the market. So with that, I'm going to illustrate, this is based on fact here, all of the different collective guesses, and you know who you are, who guessed the low and who guessed the high. We're going to say the lowest guess for the number of jelly beans was 152 jelly beans. Lucky for you, I'm not going to name who gave the lowest guess. The highest guess was 11,589. And that person was, no, just kidding, I won't say that. No, we're a friendly group here. The average of all of those guesses was 2,336. What's the actual? Is 2,527.
Wow.
You can't make this stuff up, right? This is actually the real thing. Yes. So we will reveal the name of the winner later because we don't want to embarrass anybody. But I just wanted to share with you that insight because it is something that we see in the marketplace every day. And in the news, oftentimes you'll hear of one view, but there's oftentimes different views, and those are being priced into the market as we speak. So I'm really fortunate to invite Dr. Jim Thorne here live in person to speak with us about some of the things that are really top of mind when we think about our investment portfolios, when we think about the economy, and we weigh the different factors. And so what I wanted to do was open up the conversation, invite each of you to, if you do have a question, put up your hand. We have some wonderful folks here who are going to help bring a microphone over to you. But we will have a Q&A section at the end specifically designed for questions. Okay, excellent. So Dr. Jim Thorne. So Jim Thorne joins us as our Chief Market Strategist. He just came in town from Toronto, and he was recently in New York as well. He got his PhD from York University, and he's had an illustrious career as a strategist and portfolio manager in the States. So he's very well versed with the global economic activity and some of the indicators as well, and how things really work on Wall Street. So we were just sharing stories earlier about how things work, and brings a lot of insights. He's often featured on Business News Network. This morning he was featured in the Globe and Mail, if any of you caught the article, highlighting his views. And he's really a go-to person for his insights on the economy and the markets in general. So with that, I wanted to open it up. May I call you Jim?
Of course.
Jim, on just your overall sense of where what is the current state of the markets today? And then we'll start to branch off in terms of what you think is likely to roll out over the next year.
Okay. So when I started this year, when I looked at this year, I'm big into cycles in history, right? So if you go back to 1915 and you look at midterm election cycle years, and which we are right now, there's about an election in the United States. First half of the year, you typically have a 20% correction. From 1915 on, 20% correction. Then you muddle around, and then just before the midterm election, the market starts to take off, and we rally, and we have the strongest period of time of economic growth, stock market growth coming in the fourth quarter of this year and the first 2 quarters of next year. And so when we looked at this year going forward, we thought it would just follow the normal traditional pattern. So irrespective of what happened with COVID and the war, when the historians look back at this year and just look at the data, it's just following the normal historical pattern, right? But what we do is we subjectivize it and think that this is unique, right? So that's the first thing. The second thing is what I find very interesting is the fact that we're still dealing with, in the markets, in the economy, COVID. No one here is wearing masks, right? I was in an elevator in my hotel. There were 8 people, no masks, right? But the economy is still dealing with, and the financial markets are still dealing with the effects of COVID, with the monetary policies of COVID, with the fiscal policies of COVID. And so how I look at this is we're still in a very unique period of time. This is not normal, right? In downtown Toronto, there's construction everywhere. That is government spending. That is not the business cycle, right? And so the way that we try to frame this when we talk is that we need to get back to normal, and we might be back to normal here in our lives, but we're not back to normal in the financial markets, and we're not back to normal in the economy. And so from what I look at is in terms of inflation, is we had an economy, we stopped it, and we started it. We forced everybody to stay at home and say, all you can do is buy goods. We locked everybody away for 2 years. Then we opened it up. Everybody said, we bought enough goods. So all the deflation that we're experiencing right now is in goods. And everybody's traveling. The hotel I'm at is packed. And where's all the inflation? In the services area. The last thing I would say to you, and we'll get a little bit esoteric here, is the problem with central banks and inflation is we're using 1940 variables to evaluate the 2022 economy. So when you look at CPI today, 40% of it is real estate, and of that 40%, it's lagged 9 to 12 months. So think about that. The CPI, or the inflation that you're hearing the media talk about today, is pricing in last year's real estate bubble. It is not an accurate it's not indicative of what is happening right now. If you use current forward-looking indicators, for example, the Case-Shiller indicator, real estate prices in the United States were down 0.7% in September. If you put that number into the CPI number, guess what happens? There's no inflation, right? And so the question when I write in the Globe and Mail and I talk to is do the central bankers understand this? Yes, they do. That the variables that we hear about in the media are wrong, are old. The 1940 variables were designed to evaluate a 1930s economy, not a 2022 digital economy. So why I am comfortable with all this is because this I have a job, right? I want the media to basically develop the fear, create the fear. And then when I talk to Miley's team and we talk about how do we take advantage of it. So let me be clear on this. Inflation will be back to the normal levels in the middle of next year. They will cut interest rates. So the Federal Reserve said that when inflation gets down to 2%, right, the long-term interest rate for Fed funds, which is over the overnight rate, is 2.25% to 2.5%, in that range. That means that in next year, they're going to have to start cutting interest rates. Right? That's math. That's basic math. The container ships, the price to pay for a container coming from Hong Kong or China is down 65%. Used car prices are negative year over year. I can go through a plethora of subsections of commodities in the goods space that point to deflation. The only thing that's holding the prices up is real estate prices and the bad way that the central banks understand that. Now, here's the question. In my world, we all know this, right? But we live in an instant gratification world. So the question is, do central banks understand this? And my non-consensus view, if you can imagine this, is that, yeah, they do. My non-consensus view is that everything's going to be okay. And so what happened today? The Central Bank of Canada only raised rates by 50 beeps. Now hold on. They raised it 100, then they raised it 75, and then they raised it 50. The Bank of Canada leads the Federal Reserve. And Tiff Macklin said that we see substantial signs of deflation in the economy slowing, and we're going to continue to ratchet down interest rates. It's over. Now, the interesting thing in my world, in the nuance is, guess what? The stock market and the bond market is not the economy. The stock market and the bond market are pricing in 12 to 14 months out. So when Miley's team buys a stock today, they have a time frame of 12 to 14 months out. So think about this. If you knew this, and I'm right, then you're going to have growth that's going to be slow, and interest rates are going to be cut by the end of 2023. Invest accordingly. Turn the phone off. If you're going to go on Twitter, just go to my account. Right? Don't listen to the local news. Right? And if you do it that way, then I look at this in game theoretic, as a game of strategy. So when I talk to Miley, I sit there and go, I think of this as poker. This is strategy. We want the rest of the world to think that interest rates are going up. We want the rest of the world to think that the end of the world is nigh, because that allows us to position our portfolio so that we can achieve our financial goals.
Interesting. Jim, you touched on inflation, and I think that's really on top of mind for a lot of folks because, when we think about what the data is showing in terms of food and energy costs, they are higher than they have been in recent history, and there's a lot of rhetoric around those food and energy costs continuing to escalate. So if you talk about there's deflationary forces and that actually, inflation may not be a problem, can you flesh out that thesis a bit further, especially with respect to some of the areas around inflation that people might be noticing in their daily lives?
So the big question is, I'll pose a question to you guys, right? When are you guys going to start pushing back and not paying prices that are in the grocery store? So let me give you an example. When I go to Loblaws, right? When I go to Loblaws, okay? No name soda water that's lemon flavored, okay? Before COVID, it was $4 a box, right? It's now $5.50. I ain't buying it, right? Chicken used to be a loss leader. Roast chicken used to be a loss leader in Loblaws. You walk in right at the front, $10 before COVID, okay? $15, okay? You guys gonna keep buying it? Like, you guys hold the power. right? When are you guys going to stop thinking about the fact that there is a supply chain crisis? When are you guys going to start to price discriminate, right? We are already starting to see it in the data. But look at the Federal Reserve talks about it. The Producer Price Index, PPI, that's the cost of inputs into production, right? And then there is CPI, what you pay. CPI is 3 times higher than PPI. So you want me to go back? When are you guys going to get back to pre-COVID ways and start price discriminating and walk away from $5.50 soda water at Loblaws? And I'm just using Loblaws. But that's where it comes. And they talk about, the Federal Reserve talks about it. In the 80s, who was the first company that recognized that increasing productivity in price sensitivity would be rewarded by consumers? Who was it? Walmart. Right? Walmart. Right? Nothing's changed. Nothing has changed. So stop paying $15 for the chicken. Stop buying the soda. Do you guys grocery shop? Look at the prices. I sit there and I talk to my wife. I go, I'm sounding like my father, right? You gotta know your prices. Why is it when I go to No Frills, it's $4, and if I go to Loblaws, it's $5.50? Why? So when are you guys gonna stop paying for it? When do you guys realize that the power rests in the consumer, right? So guess what? All of these retailers, everybody, I drove by the Lululemon, even Lululemon, they have massive inventories, massive. All you guys have to do is show some price discrimination and then the prices are going to drop like a stone. Because do you know what happens if they don't sell it? It becomes dead inventory. For any of you in business, do you know what that means? That's a cost. Right? Container ships going through the port of LA and Long Beach are at record lows. They are sitting on mounds of inventory and you guys are paying full price. So how long does it take for that to fill? But I can sit there and say, in the middle of 2023, prices are going to drop. Whether it's Nike, Adidas. This is the conversation I have with my wife when she walks into Lululemon, and Lululemon hasn't dropped the prices. You guys are laughing, but it's true, like $350 for a pair of stretchies, okay? I didn't know it's a Vancouver shop, but blah, blah, blah. But that's common sense, right? And then you turn the TV on, and it's like inflation, inflation, inflation. So what are we starting to see in regional Fed surveys? Philadelphia Fed surveys, a massive survey just came out. We're starting to see pushback of what? Consumers to price increases. And businesses are like penguins on an iceberg. Remember, right? Once one does it, they all follow. You just wait for the first price cuts because there's overcapacity. They will all compete on prices. And once one cuts, they will all go for market share. And so that's why I can sit there and say I'm very comfortable or write in the Globe and Mail that this is going to happen. Because nothing's changed, right? Oh, the only thing that's changed is our buying habits because for a while we couldn't get anything at Loblaws, right?
That's so true. Interesting. So then, Jim, in your view and in your study of history, what probability do you give to inflation spiraling out of control like it did in the 1980s versus a different scenario?
So it was funny, I was talking to somebody before. I have a PhD in behavioral finance, right? But you know what? What's weird is I'm a historian. I have used more and more history to go back in time and look. So the most interesting period of time for me is coming out of World War II. And so why? Why World War II? So look this is not the inflation of the 1970s. That is a false premise. It is wrong. Stop listening. You hear anybody say it, turn it off, run away. It's wrong. Okay? Paul Volcker, no. Okay? Okay? Please. Right? We had 20 years of inflationary pressures after World War II before it got out of control. Full stop. Okay? That's one. The period of time is 1945 to 1965. Why? Full stop. Let's get some things on the table. We have excessive amount of global debt. We have more debt than we did before COVID. 256% to debt to GDP of Western countries. That slows economic growth down. First off, here's the point. 256%. They can't raise rates. They're going to bankrupt us. Come on, let's use common sense. Okay? After World War II, we had 3 years of inflation above 10%. 46, 47, 48. Okay? We were worried about deflation. We were worried about the rise of populism. They were really worried about what were we going to do with all the people coming back from World War II. There was no jobs. We were going to go back. The period of the 1930s in depression was in everybody's mind. They thought they could rely on China. Nobody thought China was going to fall to the communists. Okay? 150% debt to GDP, and the size of the balance sheet of the Federal Reserve or the Bank of Canada was at record levels. There was only one way to get out of it. Grow your way out of it. Okay? And they couldn't raise rates. We had to grow our way out of it. Now, that scenario, that 20 years of doing that, okay, generated the inflation of the 1970s, along with the cessation of the gold standard and the baby boomers leaving home, and the U.S. basically 70% of their manufacturing depended on oil, which is not like it is today, right? I mean, U.S. is now an exporter. There is so many things that does not line up to the 70s. It's stark. Am I getting my point of view across? I mean, this is like, come on, right? Right? So the inflation that we have is caused by COVID. If we're not if COVID is so important and it's long lasting, why aren't we wearing masks? I know I'm being sarcastic but I'm trying to get the point of view across, right? So the way we look at it and the way we write about it is they need inflation to be a little bit high. Do you guys know what the law 72 is? You take a number and divide it into the number of 72, right? Whatever that answer is how long it takes for something to double. So if we have 6% nominal GDP, which is inflation is part of it. So let's say it's 3% inflation. And real GDP, like real, we're not taking into consideration general prices, that's 3, so that's 6. 6 into 72 is what? 12. Nominal GDP doubles in 12 years. Our debt to GDP goes down by half in 12 years. When Paul Volcker raised rates in the 1970s, debt to GDP was 35%. It's over 200%. Use common sense checkbook budgeting that you would do. So if they know this, and this is just basic math, then what the heck is going on? Right? Do you believe it? Right? How would you take advantage of it? right? When I talk to you, that's, so the map, so I always say, you know, separate the signal from the noise. And sometimes it's just common sense, basic math, that if you go through it, you know, things get clearer and clearer and clearer. So the Bank of Canada, they had Canada. Let's even go further. Canada has the highest personal debt to disposable income of any country in the G20. It's 190%. We don't have a diversified economy until we figure out what we're going to do with the green agenda, right? We don't have, what's our growth? Real estate. It's all we got. I'm simplifying it down a lot. So my whole comment is they have to pivot, and they are pivoting. They're worried about inflation, right? They should be. But to think that this is the end of the world, to think that the Bank of Canada is going to raise rates until, you know, infinity and beyond, really? I mean, it just doesn't add up. So that's why I'm so constructive. That's why when I talk to you and your team, I sit there and go, we're gonna come to an end. I mean, and the weird thing about, take the crazy COVID out, right? You know, in 1994, you had Bill Clinton in power, right? In 1994, you had Newt Gingrich in the contract with America in midterm election. For those of us who are old enough, and I'm looking at you right now, you should remember that. They raised interest rates from 3% to 6%. They thought the end of the world was nigh. The market corrected substantially. And then once they took their foot off the throat of the financial markets, the market just went up like this in 1995 for the rest of the decade. Do you know when they did that? Just before the midterm elections. When are the midterm elections?
Next month.
Oh, there you go. And so why do you sit there and think people are buying the market right now? You think I'm the only guy? I know I'm good looking and got the suit on and everything. You think I'm the only one in town that's come up with this story? Right? They just don't go onto TV and talk about it. Right? So we're in a secular bull market. Right? Interest rates have to go down. The Fed funds rate is going to go to 2%, 2 to 2.5%. Right? The rate upon which it is, it depends, but you know, that's the end point. Right? They have to get interest rates down or we don't grow. And take out the baby boomers, which is the 1990s, stick in the millennials. Demographics, they are just entering in their family formation years. You boomers, you invested, you bought houses differently. You had different tastes than your parents. You invested differently. The millennials have different tastes. They want smaller houses. They want location. They don't want the McMansions. They buy ETFs. They like crypto. They don't like gold. Now, my whole point to you is not to, as I get older, it's not to argue. It's to sit there and go, this is a demographic that is bigger than the boomers. You can fight it, or you can just say, this is where the stream is coming, this is where it's coming from, position the portfolios accordingly. And that's what we talk to the team, that's what, I say that, I bang the table, I bang pots and pans, and then I leave and they sit there and do what they need to do.
No, and it's helpful because, Jim, you've had some good insights over the past couple of years, even during the pandemic, to identify some of the things that weren't in the media and pay attention to the things like, hey, guess what? You know, the Fed might come in and actually provide stimulus when in March 2020, everyone was so worried about running to the store and buying toilet paper that they were just thinking about doom and gloom. And yet it was almost a generational buying opportunity. And so fast forward to today, I would say that, you know, your view is very non-consensus, right? In the sense that that's really helpful to bring these insights to the table today because you are identifying certain opportunities that are not commonly viewed currently in consensus. So those views may not be priced into the jelly bean jar, if you will, as an opportunity. So you touched about inflation. You talked a bit about how interest rates may not continue to keep going up higher and higher and higher. Can you relate that back to what we're seeing currently? We're still in a rate hiking cycle.
Mm-hmm.
Why is that happening when we're starting to see these other things like perhaps underlying maybe less of a need to raise rates and big debt levels? So can you explain why rates are continuing to go up in the near term, and how should we as investors think about that and position for the next 3 to 5 years out?
For whatever reason. Okay, so this is I think there's a civil war going on within policymakers, and more specifically in Washington than Ottawa. Let's just leave. Okay, I didn't even know we're being taped, but what the heck? We don't have an independent monetary policy up here. We do we follow on the back of what's happening in the United States. Okay. So there's a massive fight, and let's go back. Let's be old enough. Let's be old, and everybody remember. Everybody knows the Prime Minister, but can everybody go back that's old enough to remember his father and what his father did? I'm old enough to remember the kitchen table fights between my sisters and mother and brother about Pierre Elliott Trudeau. So there's a big concern about us going too far left in terms of fiscal policy, in terms of spending, right? It's called, in a fancy term in government or in economics, it's called the public sector crowding out the private sector. 87% of the jobs, according to the Fraser Institute, created in Canada since COVID has been created by the public sector. Okay? David Dodge, former head of the Bank of Canada, has finally come out and started talking about the fact this has to stop. Okay? So I think there is and we kind of touch on it, there is this, we are in a very 40 to 80 year period of high, we have a degree of populism, high degree of populism because of fallen standard of living, right? The American dream no longer exists. The standard of living has been dropping in the United States since the 1970s. Debt to GDP, globalization, digitization, and government and central bank policy where the belief was that any time somebody got a wage increase, that transferred into inflation. That economic, it's called the Phillips curve. That economic policy is wrong, it's flawed, and everybody knows it, okay? So I would suggest to you what happened coming out of COVID was that there was a unique situation that happened where the Federal Reserve said, we're going to make sure that the economy doesn't crash. And we're going to generate, I'm going to simplify it a lot, we're going to generate $4.5 trillion out of thin air, and we're going to give it to the Treasury, that's the White House, and we're going to make sure there's going to be social programs so that we don't crash. And they spent $2 trillion of it, and everything was fine. And then about in 2021, some people got in power and said, we've got $2.5 trillion, we're going to spend it, we don't care. Okay? That created inflation, that created pushback, that created a tug of war between Wall Street and Washington. And so if you pay somebody not to work and stay at home, does that not affect the economy? Yes or no? I have never seen so much construction on roads and buildings in my town in my lifetime. Okay? That is not the real economy. That is the government using the situation to do some things. That feels a lot like the 1970s. So I think there was a massive pushback. And I think what's happening now is there is a war, and they decided to make, and so the rationale in my last piece, right, the rationale was, forget about the rationale. They're not going to tell you. We're not data dependent. They're just going to raise rates to make sure, put the fear of God in some people, right? So I would expect that the Democrats are going to get wiped out in the midterm elections. Absolutely eviscerated. I would expect the far left agenda in the United States. Now let me be clear about this. If you came to my hometown in Toronto and we went to Billy Bishop Airport, and you know where that is, from someone from Newmarket, and we would take the 45-minute flight to Washington-Dulles Airport. 45 minutes. I go from being a staunch conservative up here, which I'm not. My political views, I lived in DC for 20 years. I land in Washington, DC, I'm a Democrat. My views haven't changed whatsoever. That's how diverse or stark the differences in the political landscape. And so I think there's a real war going on. And I think the war is people are really, really concerned of the fiscal irresponsibility that has been shown by elected officials. Don't take my word for it. Take David Dodge's word for it, the ex-head of the Bank of Canada, right? It has to stop. So I would expect, get ready for this. Forget about COVID. It's going to be debt ceiling, austerity, cutting budgets. Wait till the Republicans get control of the House and Senate, right? And we're going to go back to fiscal. Now, the next pivot when we come up here is, what about Ontario? I mean, what about Canada? What about, and I just sit there and go, you know, we take the lead from the United States. And so that is what there is no economic basis for them to go and initiate the most rapid, aggressive rate hikes in the modern history of our country, when the inflation was not caused by the business cycle. It was caused by COVID, and I will just use this term, other factors.
Very good. Thank you, Jim. I'm going to talk I want to talk to you a little bit about portfolio positioning. But I also wanted just to remind everyone, if you do have a question, we're going to go to that next, so get ready. In terms of portfolio positioning, I would say that these views are very, in line with how we've positioned the portfolio leading up into this. You know, coming out of the pandemic, we were really owning a lot of good companies that were on sale during the pandemic, positioned into a lot of technology companies that could benefit from tech spending, buying some commodities that were cheap, companies that were producing copper, for example, as everything fell into very low prices. As things recovered, we started to migrate, take profits, and move into areas of the economy and businesses that would benefit from a reopening. And that helps. We had a terrific, strong year in performance. And then towards the end of last year, we started to get more defensive inclined portfolios. Again, part of the risk management strategy is to then look at opportunities to de-risk the portfolio, and we upgraded into high quality companies, super stable dividends, balance sheets, etc. We also shortened our duration in our fixed income portfolios, meaning stayed short clients, rising interest rates in their short-term bond portfolio, and protected from big drops in the bond prices as interest rates went up. And that helps, protect client portfolios. As we fast forward to today, the sense is that there is an opportunity now to start looking at what's the next part of the cycle. Yes, there's a lot of doom and gloom out there, so a lot of global markets are down in terms of the equities and fixed income. Where would you see are the opportunities in terms of positioning, whether there's certain sectors that might be unloved and yet are good growth opportunities to, as you say, grow our way out of it? And are there any particular industries or sectors that you think would be interesting to consider adding to the portfolios?
Wow. Okay. So a lot there. So I'm from the old school. So when I build a portfolio, I start with what's the interest rate call, right? And so just go back. So I always get up in the morning, right, and I look at what the fixed income market's doing and what the currency market's doing. So what happened with today in Canada, right? The Bank of Canada. So they've gone from 75 to 25 to 50, and they had a very dovish call. So the Bank of Canada agrees with what we just said, and that is non-consensus, right? This is never going to happen again when I agree with the Bank of Canada and it's going to be non-consensus. What happened to interest rates across the board in Canada? They went down. No, wait. Hear me out. The Bank of Canada raised interest rates. They raised the overnight interest rate by 50 beeps. But the credit market over here, the real thing, all interest rates went down. Why? Why? Because the credit market says, oh shoot, Thorne might be right. And if Thorne is right, that means that we are seeing the peak in interest rates for the cycle. And so if everybody starts buying bonds, I hate to do this to you, Miley, right? If you buy bonds, that means you do what? You affect the yield. The yield goes down, right? So what is everybody doing when the yield, so this is not the government, this is not, so let's separate this. The Bank of Canada overnight rate, that interest rate, that is a weird rate. That is not a real rate. That is not set by the market. You put that over there, okay? All of the rates that are over here that are set by the market, that are set by the global markets, right? That look at Canada differently, they all went, holy smokes, the Bank of Canada's pivot, peaking Canadian interest rates are in, I'm going to buy bonds. So while the overnight rate went up, the rest of the yield curve went down. So the credit markets completely and totally agree with me. And what I want to say to you, and as I keep saying to the team, is, do you ever watch National Geographic, right? You ever watch those shows where there's a bunch of penguins on an iceberg, right? And one jumps in, and then they all jump in? That's my market, right? And so everybody's going, oh my God, we're short duration. And then you're sitting there going, if I don't buy these bonds now, my client's going to come to me in 14 months and sit there and go, I thought the Government of Canada 10-year bond was at such and such rate. Can I get some of that? And meanwhile, it's back down at 2%, right? That is what's happening. The instant gratification groupthink that is caused by this, by Twitter, right, is stark. So what I would say to you is, I am looking at, so first off is you have to deal with that, and we talk about that. Mm-hmm. So first off, I nag her, okay? I talk to the team, and I am much more blunt when we have these private meetings, if you can believe it, okay? So that's the first thing, but think about this, and I mentioned it before. If interest rates are going to be down, and growth is going to be slow, what do you want to own? And you're buying today for 12 to 14 months out. The other thing I would say, and she understands this, right? So we're going back to a low growth environment. So that's technology, right? So what are the other secular growth names? Well, isn't it very interesting? So to be very simple, you want to own the United States and Canada. And if it was me and I didn't care about the currency, I would own the United States. Just go back to the 90s, right? You own the United States. The only risk is the United States dollar has to come down because it's a safe haven, right? The United States, and what happened today? What is happening as we speak? What? The US dollar is going down. Why? Because the smart money in the world knows the Bank of Canada leads the Fed. Okay? So as I say to the teams, if you have money that's in the United States and you want to bring it to Canada, you need to work fast. If you have money that's in Canada and you want it to go to the United States, let's hold off, right? The other thing that's different and the twist is OPEC Plus. And with Saudi Arabia siding with Russia, okay? Let's just go full stop. To manufacture something, you need to go through the food chain of how to manufacture something. And the key to manufacturing is access to cheap natural resources. And the key to chemicals, which is the key to plastics, which is the key to all advanced manufacturing, is natural gas. You have a manufacturing plant in Germany, and you used to get natural gas from Russia at $2. The war in Ukraine happens, now you're getting it paying $30. Her manufacturing process in Germany is no longer cost competitive. Who just shut down European operations? BASF, okay? a massive chemical manufacturer. Europe is toast. Let me just say, be blunt. Europe is toast. All right? Think of the 1980s when the Americans came after Japan and said, you're no longer going to get free access to the United States, and dropped the equivalent of the economic atomic bomb on Japan. What did the Japanese companies do? Honda, Toyota, Nissan, everybody moved where?
US.
US. What's going to happen with Mercedes, BMW, Audi, BASF, all the chemical? Who's got the cheap natural gas? Who's got it? It's that simple. Who wins? Who wins? It's that simple.
Yep.
You don't need to go anywhere else. It's that simple.
Questions from our audience?
I have an interesting question which may be off the topic a bit,
Okay.
but with the upcoming demographics, the younger people, they're angry. I keep hearing this from other people, they're angry. And how can the anger be channeled into the investment side of things?
Okay. Maybe if I can paraphrase, and thank you for the question, around this idea of frustration from the younger generation, something we also call populism. How does that impact either an opportunity or a risk from an investment standpoint? Jim?
Oh, so if we talked 4 years ago, I would say we would never have gotten to this point because of the rise of populism. When Donald Trump got into power, it put fear into a lot of people. And a lot of the policymakers recognized that the policies that that had implemented since the 1980s fed into that, your question. So the way we get around that is we get around that by providing strong economic growth and opportunities for them. And once they feel that their standard of living is actually going up, then that angst goes away. So this is for me, if we were talking through this whole I said, I can't believe that the central banks are doing this, because this is absolutely the wrong policy, because you're getting people upset. So it's a chicken in every pot, a car in every driveway, everybody gets a house, but it's not, I know that's very pejorative and very simple, but it's not going through a period of time of extreme austerity, and it's not going through a period of time of high interest rates. And what you touch on is very profound, because if we don't deal with it, we're really close to civil war in a lot of places. And living in the States and coming back, I don't think Canadians understand the edge that exists when you live down there. And I don't think you don't realize what violence really, I'm going to use the term violence, what violence really is. I mean, I lived in a town outside, I lived in Annapolis, which was a military town. It was a state capital, had a naval academy, but you go to the wrong neighborhood and it was nasty. Baltimore is a nasty, nasty town. There are a lot of people of all races that have been left behind, that are extremely, extremely upset. That's, whether it was Richard Nixon in the silent majority, or Ronald Reagan in the Reagan Democrats, or the MAGA with Donald Trump, this is a issue that has been brewing. And what's amazing about this, you can go back to 1945 at Bretton Woods, when they were talking about how to build the economy after World War II. And people warned the people that set up the global economy the way it was, that if you build it this way, what you asked and what you said will be at the fork in the road that will have to happen. There's a great book called The Fourth Turning by Strauss and Howe that talk about this. And this is where we are. We are in a period of generational change where you've got the stress between two really, really large demographics. And what's funny, I have a daughter who's 22 and another daughter who's 19. And what I do, and they go, oh, we're gonna go march and we're gonna go do this and that. And then what I do is I got YouTube, which is great, and I pull them back to the 60s, right? In the Summer of Love, and all the demonstrations, and Gloria Steinem and Jane Fonda and all that stuff, and we're gonna fix everything. Well, guess what? What did we do? Right, I'm looking, we're all, the older generation, that was our generation, right? So we have to have a high standard of living. We can't go through austerity, and that the key point, we can't have high interest rates.
Thank you, Jim. And thank you for the question. Are there any questions from the chat? I just wanted to double check. And we'll take one final question here and then.
I wonder if Canada or North America is going to a cashless society. Any of your thoughts?
Cashless society?
Okay.
Oh.
That's what we hear.
Versus digital currencies? Is that,
Yeah.
There's a question about digital currencies versus the cashless society in Canada. So perhaps, Jim, you can touch on.
We go back to history, right? Go back to history. One of the biggest, if you ask me to rank the top innovations of the world, right? One of the biggest innovations we had is when the number 0 was brought back from Asia to Florence, Italy. And what that did was it allowed for double entry bookkeeping accounting, right? And that's the basis of our global economy today. We haven't had an innovation in double entry bookkeeping accounting since Florence, Italy, since the Medicis, right? Since Marco Polo, since Venice, since the Silk Road, right? You know what that innovation is? It's called the blockchain. And unfortunately, the first 2 iterations of blockchain were called Bitcoin and Ethereum, right? It's massive. It's going to happen. We're going there, right? It's going to, but it's like, the way I want to put it to you is just because the stock market doesn't reward disruptive technology, okay, doesn't mean that innovation and evolution continues. So the example, and I've lived this, and for us that we're in the 90s, I want us to all go back to the 1990s, okay? If we put in $10,000 into Amazon in 1997, it's worth over $25 million today, right? It lost 80% of its value 7 times, right? I can show you interviews of, do you know who Katie Couric is, right? And Brian Gumbel in 1994 sitting here going, what is the internet? And nobody's going to use email. And today, I get with my daughters in the car because everybody's walking around the road like this, crossing the street, right? That innovation is happening. Bank of International Settlements, yes, is working on it. It's already in countries. They're talking about doing it in the Ukraine. We're going to have a new internet and record keeping in the financial markets. And even though you hear people say that Bitcoin and Ethereum is a scam, I am not talking about this as an investment opportunity. I am talking about this as a technological innovation. It's happening. They're working on it. It's going to be part of our life. Get used to it. And so, yes, it's going to happen. The $100 bill is going away. Okay? The $100 bill, the Ben Franklin on the US $100, the $100 bill is going away. Yes. Going to happen. It's already in the works. Yep. Why? Why? They want to track us. They want to avoid tax evasion. You get rid of money. You basically You can't avoid paying taxes. I mean, I keep walking, I don't know, when I get I know you guys don't think I get my hair cut, but I go into the barber around the shop on Bloor Street and they take cash. I go to the guy, why are you doing this? It's a red flag for Revenue Canada, right? Right? So they're going to do it. And it's not to me to argue about it. I'm just saying there are policy papers. They had big conferences about it. They're going to do it. Eventually they're going to do it. I don't know the rate upon which the innovation is going to happen, but it will happen.
Okay. There's a very last question, and then we have to wrap up.
Last question. Good and bad infrastructure investment. It seems that and talk like this is difficult to differentiate, but there is good investment by the public sector in smart infrastructure investment, which propels the growth. So, what's your thought?
Yes. There was a paper done in the 70s. Yes, so not all debt is bad. If you spend things on projects that increase the productivity of the economy, that's good. The stuff that we've been spending it on are people sweeping the streets and filling potholes. That is bad. Transfer payments is bad. So where it's happening, and it's really interesting because the Americans are classic at this, right? Okay, everybody's focusing on pipelines. Oh, we're not building the pipeline. First off, and I'm just going to sit there. How much time do we have?
Not much.
Okay.
Yeah, we have to wrap it up.
LNG infrastructure being built in the Gulf of Mexico. It's happening. There is smart infrastructure going on. What I'm going to say is about in Canada, we signed away our energy independence with Brian Mulroney and Ronald Reagan in the 1980s in the Free Trade Agreement. All of our natural resources, our oil and natural gas, is going to go through the Gulf of Mexico. It was signed, sealed, and delivered in 1987. So stop expecting pipelines to be built in Canada. It ain't going to happen. I said that quickly enough?
No, it's so good. I think many of us could sit for a lot longer to go through these insights, and I really appreciate Jim, you sharing these ideas. I also just wanted to say thank you again for being such a valuable part of our process, and as you go forth over the next few months, if you have questions about what's happening, feel free to reach out, and we're just a phone call away. Thank you very much for being with us here today. We really wanted to thank Jim for your insights. This is a really privileged space where he can speak off the cuff and share with you in this intimate setting what he doesn't hold back really with how he feels.
That's what you're here for, right? I mean,
that's what you're here for, right? We're not here to,
We're not here to sit there. You can go turn on TV
exactly.
for the stuff, the other stuff.
As a bit of a glimpse into some of the things that we do on a daily basis with our team here on the investment side. So we just wanted to open that kimono to you and share with you some of the questions that we ask on your behalf as we go through and continue to navigate these interesting times. And we look forward to some of the opportunities that are upon us as we speak. So we're optimistic, we're positive, and we're really excited about what we see going forward. So with that, thank you again for sharing your time with us, and we look forward to being in touch.